In this section, we're going to get into the actual strategies for the trading and the execution. So let's jump into it. The first strategy we're going to talk about is called a cash secured put. So this is an income strategy and it's used during bullish or neutral markets. It's very important because you should only do this on securities that you're bullish on in the long term. So this is a very basic strategy, but it's also a very powerful strategy if used properly. So let's talk about it. It involves selling a put option at a strike price you'd like to own a stock at. So for example, let's say a stock right now is trading at $100 and you want to own it at $95. And I know you've seen this example before, but what you would do is you would sell a put option with the strike price of $95, and let's say you collect a $2 premium. So if the stock stays above $95, you get to keep this entire premium. But if the stock goes below $95, you become obligated to buy 100 shares of the stock at $95. Again, I know you've seen this example, so now let's jump in to put actual numbers to see how this trade can be executed. Right here, we're looking at QQQ. All right, today is June 17th. So we're gonna look at something that's a little bit further in expiration, around 45 days. That's the July 29th. QQQ is trading at 275-ish. To determine which strike price I'm going to use to sell the put option, I use deltas. The deltas is actually a proxy for determining whether a stock's going to be in the money or out of the money. So this negative 0.25 delta right here, or 0.249, indicates that there's a 24.9% chance that QQQ, which is trading at 275, will be at or below 254 on July 29th expiration date. And so if we're looking at this, and let's say we want to enter into this trade, we would right click, click sell to open, and you need to make sure you have options approval. You don't need level 4, I have it. Make sure it's QQQ, change it to one contract, and then you click sell to open, this button right here. I don't actually want to execute this trade, so I'm not going to. And when you sell to open, remember, you're selling at the bid. The bid is the highest someone is willing to pay for this contract. So if you need to sell a contract, you would sell and you would get $5.63 per share. But remember, each contract is for 100 shares. So you would get $565 to accept the obligation to buy 100 shares of QQQ at 254 at or before July 29th, 2022. Now, if the stock stays above 254 by this expiration date, that means you get to keep the entire premium. Again, the market is open, so you can see these prices adjusting while we speak. So that's how you enter into the position of opening this cash secured put. So to execute this trade, you need $25,400, 100 times the strike price, to basically execute this trade. Now, you can do it with a lot less if you have a margin account, but I don't recommend that unless you know exactly what you're doing. When you're just getting started, I'd say stick with just a cash account. That way you can't get a margin call. Everything will be better this way and you can actually lower your risk. So you need $25,400 to enter into this contract. You make $5.59 per share, so $559 per contract to accept the obligation of buying 100 shares at 254. So that's how you enter into the trade. Now in the next video, we're going to talk about how you can exit the trade at a profit.